Welcome to the Freedom Capital Management Strategies Quarterly Market Review and Outlook. I'm Brian Zabor, Investment Director. I'm here with Pete Murphy, Chief Investment Officer. Pete, equity markets were exceptionally strong in 2023. That rally continued in the first quarter of 2024 as we saw major markets around the world at or near all-time highs. This included the Dow and the S&P in the US, the Stock 600 in Europe, and the Nikkei in Japan. US markets again led this past quarter. We did see some broadening out. The Mag 7 wasn't the entire story this past quarter. We saw good returns from small caps, international, other indices. Could you take us through some of the drivers of financial market returns?
Thank you, Brian, and thank you all for joining us today. As Brian mentioned, for stock market investors, it was another great quarter. And when we look under the covers to unpack what happened and why, there wasn't a whole lot of noteworthy or newsworthy events that really drove this outcome. It was just continued strength in the US economy and increasingly in the international economies as well. When we look at the US economy, gross domestic product grew at a 3.4% annual rate in the fourth quarter. This is a very strong rate of growth and continues on the strength that we saw for much of last year. In addition, and even more importantly, much of the economic data that was released in the first quarter positively surprised expectations. And what I mean by that is the data was stronger than most economists and investors were expecting. And when you get these positive surprises, it tends to be a very strong positive catalyst for stock markets. In addition, not only did the economy generally outperform expectations, corporate earnings also did as companies produced strong results in the fourth quarter that really led markets higher in the first quarter of this year. So you had this really powerful combination of strong economic growth leading to strong corporate earnings. Finally, we really saw the recession fears that were prevalent at the beginning of 2023 really abate and fade off into the distance. There's very little talk of recession any longer. The economy has just been incredibly resilient. And as those fears have receded for investors, it has led to growing confidence, and that's led to higher stock markets. So a really positive confluence of factors in the first quarter of the year.
Pete, so equity markets were very strong in the quarter. Conversely, in the bond markets, we saw a modest decline after a very strong fourth quarter 2023. Could you talk about why the difference in performance and what was the disconnect to this past quarter?
The bond market and the stock market really move to different factors and are driven by different factors. So we talked about the gains in stock markets and what drove it with the economic resilience and the strong corporate earnings. The bond markets, on the other hand, are primarily driven by interest rates. And when we look at interest rates in the first quarter of this year, they generally moved higher. And higher interest rates generally lead to lower bond prices because they're inversely related. And what drove interest rates higher? First and foremost is inflation. Inflation is one of the primary drivers of interest rates. And while inflation has declined or decelerated quite a bit since the peak levels reached almost 2 years ago, inflation overall remains elevated and higher than it has been through much of recent history, but also higher than the Federal Reserve's target of 2%. And in the first quarter, we had a couple of data points come out, both for consumer price inflation and producer price inflation, that were higher than expected, or hotter than expected, as many would say in the markets. And that led to some repricing higher in interest rates, which led bond markets lower. In addition to that, investors entered 2024 expecting the Federal Reserve to begin cutting interest rates, and to do so pretty materially. At the beginning of the year, there were expectations for 6 quarter-point rate hikes by the Fed, which would have equated to about 1.5% lower interest rates over the course of 2024. As things progressed during the first quarter, market expectations went from 6 quarter-point cuts to 3, so cutting that in half. That means the market is expecting interest rates to stay higher than was initially anticipated this year. So that also led to some challenges in bond markets. So we really saw different dynamics moving the stocks and the bond markets in the first quarter. And in summary, the strong economic growth really trumped higher interest rates in stock markets and allowed stock market indices to achieve new highs. Conversely, in the bond markets, the higher interest rates served as a weight and generally led to lower prices in bond markets over the course of the quarter. So two very different narratives playing out across stock and bond markets last quarter.
That's a great recap of what happened in financial markets this past quarter. Looking forward, it seems like a lot of momentum with the economy, with the financial markets. What could possibly go wrong? What do you see as far as some risks over the next couple of months?
There's no question that the balance of economic data is decidedly positive right now. And that's why we have such a positive dynamic playing out across financial markets, especially in the stock market, as I spoke about earlier. But when everything is looking positive and the outlook among investors is generally one of optimism, there generally becomes less of a concern about what could go wrong, but those are often the most important times to assess what are the risks and just to recertify that your portfolio is in a healthy place given the broader macro environment. And when we look at the potential risks that are on the horizon, there are really three that stand out for us that investors should be monitoring as we progress into the second quarter of the year and beyond. First is the job market. The job market has been a beacon of strength since really the pandemic, and through recent years, it has been remarkably resilient. We've seen strong job growth over the last couple of years. We have a historically low unemployment rate, the lowest in decades. And by most measures, the job market is very, very healthy. However, there are some early signs of more leading indicators in the job market that suggest the job market may be cooling off a bit and maybe slowing a little bit. Some examples include reductions in the number of job openings. Job openings were exceptionally elevated for the last couple of years, meaning that there were many jobs available and not enough workers to fill them. We've seen those job openings steadily come down. And while not yet at a concerning level, the trend is certainly one of lower job openings. We've also seen fewer workers quitting their jobs voluntarily. And generally speaking, when workers are confident about their prospects of getting a new job, they're more likely to leave their current job in search of a better job or higher wages. We've seen fewer workers who are voluntarily leaving their job. And we've also seen some declines in temporary employment, which is also a leading indicator as more people get pulled into the labor market. So certain signs that things may be cooling off. I'm not suggesting in any way that there's imminent disaster in the job market. Overall, it's still incredibly healthy, but some of the leading indicators suggest things are slowing down. So something important to watch. Second is inflation. I spoke about this earlier. While inflation has materially slowed from the very elevated levels of the last couple of years, it remains stubbornly high. And we've heard from Federal Reserve officials and others that they're still monitoring this very closely because they're not yet confident that inflation has been durably tamed. And so with inflation so fresh on their minds and the risks of inflation that really played out in markets in 2022 in a meaningful and pronounced way, inflation that is higher than expected or inflation that doesn't decline to the level that is hoped could really rock markets over a short-term basis. And while it's not our base case that could happen, there are certainly risks with wages still elevated and wage growth still elevated, and some of the inflation prints that I spoke about earlier coming in higher than expected. So inflation is another area to watch. And then finally is the widespread investor optimism that seems to be taking hold among markets. I spoke earlier about everything seems to be in a really healthy place for the economy and the markets, and markets are responding in tow. However, when a lot of good news is priced in, which is certainly signaled by markets achieving all-time highs, we've seen credit spreads in fixed income markets get to very, very tight levels historically. These are signals that financial conditions are getting easier. Investor sentiment is very optimistic. And when that happens, the risk of disappointment grows. And so investor sentiment is typically a contrarian indicator, and growing optimism can actually be a sign of growing risk. So this is also something we're watching closely.
Pete, thank you for those insights. We talked about how strong equity markets were in the first quarter. However, coming into 2024, it felt like there are some headwinds for equity markets. We had the upcoming US elections, we had continued tension with the US and China. We also had a lot of geopolitical risk with wars in several parts of the world. Could you talk about, as you look forward, what are some advice you could give investors?
First is to stay disciplined. We speak about this often, but it remains the most important feature and factor for investors to consider. And it's hard to do. There's much emotion tied to financial media and the headlines associated with newsworthy events. But when we look at financial and investment planning, a focus on the long term and staying disciplined is incredibly important. And we've had some really powerful experience with this the last couple of years. If we just look at financial markets over the last few years, investors entered 2022, 2 years ago, very optimistic because 2021 was a great year for markets and the economy. And what ended up happening in 2022? We had a strong surge in inflation. We saw broad-based declines in stock and bond markets, and we really had financial markets rattled. And then as we entered 2023, investors started feeling very pessimistic. There were widespread expectations of recession that was imminently on the horizon and thoughts that financial markets were going to struggle again in 2023. What actually happened? We saw stock markets and bond markets generate strong gains in 2023, and we saw the economy be much more resilient than expected in no recession. So it's really important to keep in mind that emotion is a powerful driver of the way that we are feeling about our investments, but not always the best guide to the way that our investments should be managed. So staying disciplined, staying focused on a long-term plan is really, really important. And then secondly, focus on diversification. It's tempting with the strong gains we've seen, especially in large cap US technology stocks that are tied into the artificial intelligence theme over the past year or so, to want to concentrate in those types of investments. And while those are great companies, they're probably not the only companies that should be represented in your portfolio. They've grown more expensive from a valuation perspective, which increases risk. And it's important to add other elements into your portfolio to diversify some of that risk, whether it be other parts of the stock markets, fixed income assets, or other asset classes that are in the marketplace. And then finally, and most importantly, stay engaged with your financial advisor. Make your financial plan a living plan.
Pete, thank you for those perspectives. Thank you for joining us today. We look forward to updating you on economic and market trends in early July.
Thank you.